Let's get straight to it. First and foremost, do your own research. Using trust with whole life participating in DR policies. First thing we want to do is establish a irrevocable trust. We're going to use that trust to fund the policy. First, we got to get approved for that policy, right? An NDR to be exact here in this case. That's approved because it's a risk product. You're not just going to walk in like a checking the savings account, show your ID, whatever, and get one. No, it's a risk policy based on your health, your life, etc. So you have to get approved. We're going to use the trust to fund the policy using crummy powers. These three little piggies here, they got 30-day option to actually withdraw these funds. 30 days. Remember that. Without that 30 days, they don't do that. You can take those funds and put it right into the policy and get some taxable exclusions. I'm not a tax accountant, just know some shit. So follow me, continue to follow me here around this road. LPOA option. I have an LPOA option, which is basically overfunding the policy, right? So you get a $6,000 premium for this example, which is the required amount to be paid, and the optional $44,000 every year that they want to put inside this policy, which is a total of $50,000 annually if approved into this policy. Again, the $44,000 at their discretion. Let's say one day, a year down the line, they want to take a loan from the policy at $30,000 with a 6% interest rate. You might be like, oh, that's crazy and insane. No, it's not, because what the company allows if you take a loan and not withdraw it is your money still grows. So that $44,000 LPUA, maybe say 47, depending on the situation, it can continue to grow and compound, let's say 6 to 7%. Now, this is depending on rates and everything like that. If you get that kind of percent, recently it's been about 4 or 5, high 6, and you could take that money and actually get a high potential return investment somewhere else. You might want to say real estate and tax liens and deeds and business investments. Well, let's look at tax liens. Rate of return can be anywhere from 5, 10, up to 30-something%, depending on your state. Redemption periods vary as well. Let's say 10% was your minimum gain. I like to play the minimum gain because, you high expectations, you end up getting sad when you don't meet. Let's say 10%, negative 6%, because I have to pay that back over there. I get a 4% spread, and I go over here, guess what? My money still grows as if I never touched it. I get 4% here, and my money at that 44, 47,000 still continues to grow. Isn't that awesome? Let's continue. What we're going to do is, after that happens and life goes on, we're going to establish a second trust throughout this process, right? And a foundation. The beneficiaries, of course, gets the death benefit. Got your little piggies here from the very top, from the beginning. You may have your family trust that generate future value, wealth, businesses, and actually enforce behavior patterns, which is the greatest asset of all trust. Also, we have the foundation, which can help with our MEC limits. If we go over the LPUA option amount that they allow us to do, that amount is taxable. We can use it to possibly even donate to foundations, which is in the form of a charitable giving and other legacy purposes. This is an awesome product. If you want to find out and learn more, follow me on YouTube at Living Equity, on TikTok at Living Equity, on Facebook as well. Hopefully we'll see you guys soon.